to BloombergQuint. You're watching IPO Adda, and the company in focus today is FS and E-Commerce Ventures Limited, the holding company for NYKAA e-commerce portal. And joining me is Falguni Nayar, who is the chairperson, managing director, and CEO of the company. Falguni, welcome to BloombergQuint, and nice to have you here in the new stint as an entrepreneur and not an iBanker. To begin with, let me ask you the tough question: how do you value this IPO?
I leave it to the experts like the investors and the analysts and the bankers to value the company rather than value it myself. I think we are very focused on building a great business which has long-term sustainability and potential for high growth and potential for delighting the consumer. So always build this business with first principles, and then true value will be discovered. We've been very patient and not chased neither just the top line revenue growth nor just the valuation, but try to build what we call as long-term sustainable company with a great consumer connect and what we call as brand love and trust that we enjoy from our consumers.
Falguni, I just want to get a clarification on the valuation part because last year in March, you had given you had allotted to a private equity at 201 rupees. In June, you had allotment to the promoter family at 359 rupees odd, and now we are pricing the IPO at roughly around 1125, which is the upper end of the price band. From $2.2 billion, the valuation has now close to $7 billion. That's the reason I'm asking, how do you justify that $7 billion valuation?
So I think if you look at the fundraise that we did from last external investor, which was done during April, it was a COVID impacted month. I think the transaction was being considered at a time when COVID had hit us. And I think from certain perspective, we saw need to really bolster our resources ahead of what we would have liked to do then. And at that point, certain other investors also wanted to some of our existing investors wanted to place at least some amount of their stock. So I think that valuation was right in the context then. Since then, I think NYKAA has continued to grow during even COVID impacted times. And all of that, those numbers are in the prospectus. So even between financial year 2019 to 21, we've grown at a CAGR. GMV has grown at a CAGR of 56.6% in spite of COVID impacted year. In the prospectus, we've also shared the Q1 number for financial year 22, where I think on beauty itself, we've grown 12% quarter on quarter from fourth quarter last year, or 178% year on year growth in beauty. And in fashion also, we have grown 43% quarter on quarter, and of course 9x from previous year comparisons. So April, May, June of 2022, financial year 22, has been, in spite of being again COVID phase 2 impacted, our business has been very strong. Also over the last 1.5 to 2 years, we've set up fashion business, which has scaled very, very nicely over that period. I think in the fashion business, we have grown, at a very, very fast pace and got established. So I think all of that is reflected in the valuation. As far as the promoter placement is concerned, it is more like it came out of a issuance to the promoters done 3 years ago, and these things were subject to reaching certain milestones on growth, profitability, and turnover, and mainly on turnover and also growth, and certain milestones that the company was meant to achieve. So as you are aware that these things are issued at valuations which were at that point in time 3 years ago, and they can be exercised 3-4 years later. So the exercise has happened now, but the issuance was done a couple of years ago.
Falguni, I was looking at your EBITDA FY 21 EBITDA margins were 6.6 or 6.1%, and in the first quarter the EBITDA margin has halved. What was the reason for that? I'm seeing stock in trade also increasing and higher inventories. Was there a higher discounting that happened during this first quarter, which led to dilution of EBITDA margin?
No, I think the first quarter of financial year 22 has to be seen vis-a-vis the first quarter a year ago. And when you see it, because both were a little bit COVID impacted, So if you look at it from that perspective, we have a large physical retail presence. And while e-commerce was very strong in this year, financial year 22 first quarter, the physical store network were impacted. So certain costs were higher, and that's what affects the EBITDA margin. And also we press the pedal on marketing, because I think in a post-COVID environment, one wants to get onto a higher growth path from a customer acquisition perspective. So I think some of it is a combination of these two. Otherwise, the core profitability of the firm remains good. I think I want everyone to understand that for an internet company, there is a choice of customer acquisition and the balance between returning customer behavior and new customer acquisition, and the pace at which you're acquiring new customer can sometimes in the near term affect the margins, especially the EBITDA margins, not the gross margin, but the EBITDA margin, because you're investing for the future. Also, there is certain seasonality in our business where October to December is our strongest quarter. So the full year number has the benefit of that quarter, those couple of quarters. Second half, which is October to December, and then Jan to March, tend to be stronger quarters. So I think everything has to be seen in the context of that.
Ishan?
Right, Falguni, I also want to understand, Nykaa was the first one to jump on the cosmetic bandwagon in the country. Now the market has changed. Both, large e-commerce players such as individual companies such as Purple, MyGlam, all are eyeing a larger market share in the category. What will be your strategy to defend your turf and also expand at the same time?
So I think first of all, Nykaa didn't necessarily have own. I mean, first of all the competition we have now today has existed since 2012. So be it Purple or any of the large horizontal platforms like Amazon or Flipkart or Myntra have always been in existence from 2012. MyGlam is not even a multi-brand retailer, so we should talk more about the multi-brand retailers first, which is where we are. We are more of a multi-brand retailer first. And from a multi-brand retail perspective, I think Nykaa has always done very unique things and created, I think we grew up in a time where everybody used to ask us, what is your moat vis-a-vis Amazon? So we are very well aware, and we build certain what we call as moats or strengths in the company that are today unmatched by others. So first and foremost, we are an omni-channel business. None of our competition stacks up on an omni-channel business model, and we do believe that this business needs an omni-channel presence. Secondly, we have a large presence of premium and luxury brands, and many of those exclusive to us, including many of the international brands like Huda and Charlotte Tilbury and many more like Pixie that we bring to the consumer. And we think that's a very substantial part of our business. It's there in the prospectus, and we believe that, again, there is a very unique competitive moat that we have created there. On top of that, of course, we have some of our own brands and the content-led commerce that we do, and all the channels and assets that we've developed over the years, be it our Instagram presence or be it our Explore channel that we have on our website, all the education that we do around it. Many of these things are very unique. And yes, of course, we've been very lucky that we've had hardly any competition, especially at the premium end of the business. And it's all there in the prospectus level of competition we have. And one has to do the right thing in terms of continuing to mean a lot to the consumer and adding value to the consumer in such a way that that you move ahead in this industry compared to others. You move at a faster pace and offer more to the consumers.
Right. And you mentioned about your own brand as well. There were about 15 Nykaa owned brands.
We have a lot of our own labels across beauty.
What's the revenue shift like? How much of they contribute to the overall?
We always believe that we are a multi-brand retailer first. So we have shared it in the prospectus that these brands contribute around 7% of our net revenue.
Mm-hmm.
But that's across all brands, across beauty and fashion, across all brands, with a lot of space we play in. So our own brands don't address every space, right? So it's a market share across the platform.
And what will be the next big segment for you? You have expanded, diversified into jewelry, accessories, men's grooming. So besides the beauty segment, what is going to be another segment that is going to be a revenue driver or GMV driver for you?
I think fashion is a big business for us. We do believe that, beauty is a $16 billion market today and likely to grow to $28 billion. Fashion today itself is a $54 billion market, growing to $124 billion over next by 2025. These are all red seer estimates which are there in the prospectus. And I think from our perspective, online is only 8% of beauty penetration and fashion is about 12%. So we do believe that there's a lot of potential for online penetration to increase in both these categories, and that will give Nykaa a great runway to grow. Within that, we are, of course, we have our own brand business, we have a physical retail support to the e-commerce business as well, and which itself is a very big opportunity. And we've also recently launched our eB2B business called the Superstore, which sells beauty products to retailers. So we want to be a total player in the ecosystem of beauty and fashion, so that we carry all our, we carry the industry participants with us.
Falguni, your growth has been very impressive in the last 3 years. But if you look at the revenue to GMV ratio, it has fallen in the first quarter to roughly 55%. If you compare year on year, it was 66% in last Q1 of last year, and now 55%. And for the financial year FY21, it was 60%. What is the reason for that fall in revenue to GMV?
I think we do beauty business through an inventory-led business where our net revenue consists of the products that we sell as a retailer. The fashion business, we do it through marketplace, where our net revenue is only at take rate that we get for selling those products online. And hence, those two are not exactly comparable. The comparable number for both would be gross merchandise sales, which is not there in financial statements, given the way the financial numbers need to be reported. And as the percentage of fashion business in the company is going up, it looks as if the ratio of net revenue to GMV is adverse, but it's not really adverse because it is the differential, accounting. But at the core level, we believe that our beauty and fashion profitabilities are very similar.
And what are the margins for your BPC versus fashion? What kind of margins both the segments have for you?
I think in the financial results, we declare gross margins, and the gross margins for the firm have been around 40% level, but we had disclosed that during the COVID year, because these gross margins also include revenues that we receive for advertising income besides the sale of products. So I think we had disclosed that it was impacted slightly during that period, but since then, so I think if I give you the numbers, financial year 19, the gross margins were at 40.6%. 20, it was 42.6%. It came down to 39% in financial year 21, mainly impacted by certain ad income.
I get the gross. I'm talking about the margins for BPC, which is beauty and personal care, versus fashion. What kind of margins you work on in these two segments?
So like I told you, because in one case net revenue is a selling thing and the other case it's the take rate, they are not comparable. In fashion, the take rate is the net revenue, and as a result, there is no cost of goods sold. So I think the two are not comparable, and hence it's difficult for me to say it here. But what I'm trying to say is that to us, when we look at the unit economics of both the businesses, they are very similar. At the moment, fashion is loss making because it's at early stage of the business, and we are investing in marketing, where we are investing for the future and customer acquisition. But over the long run, we do believe that the unit economics for both the businesses would be similar.
You made certain acquisitions, 20 Dresses, then you had Dot & Key in the last couple of years. How are they progressing, and what kind of expansion strategy you have for them?
So 20 Dresses is one of our older acquisitions, and it has progressed really well. We are really happy with the kind of momentum it is getting in terms of customer acceptance and the quality of the products and designs we are able to bring to them. Then we also acquired a brand called Pippa Bella, which is a jewelry brand, smaller market size, but again an extremely interesting brand that has a lot of consumer appeal. And Dot & Key is a very, very recent acquisition. We just announced it now. It was done around towards the end of September, so it's a new acquisition. We do believe that skincare category has a lot of potential. and we needed an additional brand to be able to serve the consumer need in this category. So with that view, we had, of course, some amount of skincare offering under Nykaa Naturals, but we have acquired Dot and C also. So we remain very excited about the potential for what we can do on the skincare side for our customers.
Nishant?
I just want to understand one last bit also. Some may argue that your strength lies in sticking to the core, which is the beauty and wellness market. You have been expanding. What is the need? Because the market that you're also expanded has a tons of competition already. What is the need of expanding beyond the BPC verticals?
I think it was not need driven, but it was an opportunity driven. We did believe that we had a certain appeal to the consumers, which were looking at discovery led consumption and education and discovery led consumption. And we believe that that same opportunity that we had so nicely addressed in beauty, in a similar way, we could address it for fashion. We are a believer in vertical commerce. And as a result, we are not trying to add everything to the main website. We have a separate app for beauty. We have a separate app for fashion. Now that we're expanding to men, which account for half the population, and we said, why not take similar offering to men's also? So that is another app. So we think we believe in vertical commerce and the discovery-led commerce, and that's what we are offering to our consumer. And we do believe that there is an opportunity for us to play a wider role in the ecosystem.
It's not going to act as a distraction for you?
It's not a distraction. It is, of course, needs to be done in a very focused manner with the right team. Very often we have the right separate team which is building each of the businesses. So it's not just we don't just, beauty business team is intact. And we've added to that the entire fashion team, which is building, fashion offering from assortment perspective, which is building relationship to fashion brands, which is actually building the technology platform and also the operations, which are very different. Like for fashion, we had to do a marketplace way of operation, whereas for beauty, it was inventory led. So nothing is automatic plug and play. It's a very conscious growth in a new vertical that we believe in.
Falguni, you since 2012 you have invested 577 crores in primary capital, and you've scaled up the business to this level. Now you're raising another 630 crores in primary capital. My question is that will this capital be enough for your entire expansion plan for another year or two, or will you needing to come back to the market and seek more capital, as e-commerce would need a lot of capital because for your marketing initiatives or expansion of warehouses or whatever?
I think, we've given the use of proceeds in the prospectus, and it is mainly to build our stores as well as our warehouses, as well as certain amount of customer acquisitions and general corporate purposes. We do believe that we have provided for about a year and a half to 2 years of capital requirement in this fundraise. However, of course, should the market opportunity expand further and should we need to raise some more money, we can, of course, as a listed company, come back to the market at a certain point in future, maybe a year later or sometime in the future.
Because fashion is a very competitive market for you. You have Reliance in it. You have Tata getting into it. You have the Mintras of the world who are already in it, and it's getting crowded as well. Will you be needing more capital for fashion to grow?
No, I think we have enough funding currently available for our plans for fashion business over the next 1 or 2 years. I think, in our opinion, fashion is such a large market, as I talked about it, $54 billion market, growing to $224 billion. So it's not one person takes it all market. In fact, it was quite unfortunate that actually no one had been able to cater to online fashion in a very meaningful way except Myntra. And about 2-3 years ago, when we were looking around, there was a space available. And that's how we consciously decided to enter the fashion market. And whether you look at US or any of the developed markets, there's so many players, and fashion can definitely support many more platforms and brands. So I think we even if we get a small percentage market share in the fashion business, it can be a significant business for Nykaa. And I think Nykaa has a very unique offering in fashion, which is again, trend-led, fashion-led, on-trend fashion and more discovery-led. And I think that's how we're going to service rather than do head-on competition vis-a-vis other players.
So your future growth would be more debt capital led or equity capital led?
It will be balance. I think we will continue to have debt financing for our inventory-led businesses, and sometimes some amount of debt financing for our capex. But otherwise, rest of it would be equity-led. But I don't think we need to dilute so often unless we find some good acquisition opportunity or something. Then we may consider some fundraise.
The reason I'm asking is that uh, being in India, where you have restrictions on foreign capital coming in, as promoters, you will always have to have more than 50% of capital bringing in every time there's an equity requirement. And that's the reason I was asking, is it comfortable? Do you have a comfortable capital situation at this point in time if you look at 1 to 3 years in going forward?
No, you ask a very interesting question, and I'd like to clarify it that not we as a promoter, but Indian ownership needs to be at 51% and more. And to that extent, a number of Indian high net worth individuals who own the company, or even Indian retail mutual funds, as well as the retail investors who will come into the IPO, all qualify towards that 51% that needs to be Indian owned and managed.
So
Right.
you are comfortable with the borrowing limit, right? That's
Yes,
what I'm
of
trying
course. I mean, 51% Indian owned and managed is a very comfortable position to be in,
to.
given
Nishant?
NYKAA'S historical shareholding
Mhm,
pattern. Sorry.
mhm. On the lighter side, just want to understand, how does it make you feel that you're going to be listed now? Was that always a part of the plan? That's the future you
Yeah,
saw for NYKAA, and what is the road ahead?
yeah, I do see. I mean, having been an investment banker who did a lot of IPOs, I can say that I was always a believer in listing being that ultimate, I mean, you can call it like a graduation for a human being where you go into the listed space and then you can hope to have a long-term journey and life of your own. So I think it makes a company independent of the promoter in that sense and allows it to have a long-term sustainable legacy or a journey ahead. So I think for me, it is like growing up, and I think it's something that I always wanted for NYKAA, and I'm just happy that we are at that point today.
Falguni, you brought in so many companies to the market, and now you're taking your own company to the market. The burden of expectation is so much on your on you and your company. Are you ready for the kind of expectation that that market is now expecting from e-commerce companies? We've seen in the last 3-4 months how e-commerce companies have been valued, how stocks have been running up for them, and how market expects more from these companies.
Yeah, so I think basically from Indian e-commerce companies or Indian tech companies, what market sees is a very robust demographics. We've all talked about Indian demographics, young consumers who are coming of age and entering the working population, and what that does to consumption in many of the sectors and services, is what actually investors see as a long-term potential, and that's how they are long-term convinced about the prospect of the Indian market. Within that, what the companies need to do and is that they need to make sure that this opportunity is tremendous. However, to be able to succeed in the long term, you also need to survive in the short term. So I think the strategy of a company needs to be very balanced between, investing for the long term, but at the same time managing your economics from a short term perspective. And especially when there are market cycles, because that's what we saw in early stage of e-commerce, like 2015 to 2018 and all. I mean, when the funds are not so easily available, how at that point people talk about what's your burn rate and do you have enough to survive into the future. So I think it's very important to balance between growth and growth opportunities versus creating a robust business model that protects you against the market risks that come up in the short term.
Finally, Falguni, your biggest advantage has been that you enter the tier 2 and tier 3 markets, which now account for nearly 62% of your GMV. How do you see those markets developing? Do you see the growth rates coming much faster from these two markets, tier 2 and tier 3, as compared to metro urban cities?
Yeah, absolutely. I think the tier 2 and 3 cities are growing faster than the metro cities. Of course, the metro cities are also growing. It's just that as the as you are aware that the internet penetration and all the influence, the social media and all the content penetration in these cities is very high, and that is driving for their aspiration and hence their consumption. So as e-commerce companies service these markets in an efficient way, and the consumer there have a positive experience, they are embracing more consumption from these platforms. So I think it's a very unique opportunity. I think vernacular will have a role to play, more of more of what we call voice compared to voice will have a role to play. So I think all of us companies are working towards doing more education, doing more communication in vernacular languages, and also through voice in a way that consumers can feel better about what they want to buy.
Falguni, it's been a pleasure talking to you today. All the best for your IPO. The FSN E-commerce Ventures IPO opens on October 28th and closes on November 1st. A price band of 1,085 to 1,125, giving the company a market value of 53,204 crores. Thank you very much for joining us on BloombergQuint today.
Thank you very much.
Thank you, Falguni. Wishing you the best.